Welcome to this week's edition of Macro and Flows from Orestes Capital for the week ending on May 22, 2026. We're Elena and Marcus.
And, if we look at the current setup, imagine driving a car at 100 miles an hour, completely blindfolded, while the engine temperature gauge on the dashboard it's flashing red. That is the precise position the average individual investor is in right now.
Right. And if you are watching the financial news networks this week, you are basically being fed a narrative of pure stability. I mean, the headline indices appear virtually flat, which projects this illusion of a calm, predictable environment.
Exactly. But beneath the surface of those stagnant numbers, there is a massive structural shift actively rewiring the underlying market engine. And that brings us directly to our proprietary modeling. To understand the actual architecture of current asset prices, you really have to entirely bypass those consensus headlines.
You do, which is why we want to start by breaking down exactly what our primary house view is signaling. For those managing their own portfolios, the foundation of our analysis relies on the OCM PCA model.
Right, the PCA model.
Yeah.
And it is critical to understand exactly what this tool does. PCA stands for Principal Component Analysis. Now, it is not a predictive crystal ball. Rather, think of it as a set of institutional noise-canceling headphones.
That's a great way to put it, because every single day, the market generates just an overwhelming amount of static. You have random price fluctuations, reactionary day trading, and obviously all the media-driven sentiment.
Exactly. And the OCM PCA model mathematically strips away all of that daily noise. It filters it out to isolate the primary, hidden macroeconomic engine that are structurally dictating the true direction of asset prices.
So when we run this week's data through that model, the signal we receive is completely unambiguous. We're structurally anchored in what the model formally classifies as a euphoria and reflation regime.
But the internal dynamics of that regime are shifting rapidly. The check engine light is on, so to speak. The absolute intensity of our primary market engine, which is a global growth factor, is steadily and definitively cooling off right now.
Right, and we can see that in the standard deviation data. We tracked a clear deceleration from a peak earlier in May, where the standard deviation sat at a very strong positive 1.42. But as of this week, that metric has dropped down to positive 1.21.
And that specific deceleration from 1.42 down to 1.21 is the critical data point that the prevailing narrative is entirely missing. The consensus across the street remains completely fixated on a very narrow artificial intelligence growth story.
They really are. I mean, the market intelligence you read daily suggests that strong corporate fundamentals are driving the bus. But our proprietary modeling proves that current pricing has completely decoupled from actual economic data surprises.
Exactly. The underlying growth engine is stalling out, yet asset prices are still climbing. So mathematically, this tells us that the market is now entirely reliant on pure momentum rather than foundational growth.
Well, I want to pause here and challenge the model's terminology for a moment, specifically the use of the word euphoria, because if you are an investor looking at your screen right now, market breadth is incredibly narrow.
Is extremely narrow, yes.
Right. The gains are heavily concentrated in just a handful of mega-cap technology names. Broad market participation is actually exceptionally weak. So how does our proprietary modeling mathematically justify labeling an environment with such narrow leadership as a state of euphoria?
Well, it is a necessary and highly specific distinction. In the context of the PCA model, euphoria does not mean every single stock is going up, or that the average retail portfolio is universally outperforming.
So it's not about broad participation at all?
No, not at all. Mathematically, the model defines euphoria based on extreme capital concentration in hypercyclical assets. Right now, we are tracking massive capital flows into industrial inputs, specifically copper, alongside really heavy positioning in emerging markets.
Right. So the model registers this as an extreme, synchronized global bet on an industrial boom. It is a mathematical euphoria of risk appetite, basically a concentrated leveraging of capital rather than a healthy, broad-based equity rally.
Precisely. Which brings us to a central mystery that directly impacts your portfolio. If that fundamental growth engine is definitively cooling, dropping to that 1.21 level we mentioned, why hasn't the market corrected?
Yeah, who exactly is providing the massive amounts of capital required to keep the broader market propped up near its absolute highs? Well, the data points to one specific group, and that is retail investors.
Everyday traders are currently acting as the market's primary liquidity providers. Our market intelligence shows that retail trading volumes have surged 28% since mid-April. They now account for approximately 20% of total daily market volume.
To properly contextualize that figure, individual investors are averaging $1.8 billion per day in net buying this month alone. But here's the most striking metric we're seeing. There have been 0 sell imbalance days in the past 7 weeks.
0. We are witnessing a persistent unidirectional flow of retail capital that is completely undeterred by the cooling growth factor.
Just to emphasize the gravity of that metric for the listener, 0 sell imbalance days in 7 weeks. That means for nearly 2 months, everyday investors haven't blinked once. They have bought every single day without a single session of aggregate selling.
Right, and that is not just a bullish trend. That is historical blindness to risk. Furthermore, retail margin balances, which, is capital borrowed from brokers to buy equities, have climbed rapidly back to the extreme highs we previously saw in 2021.
And when you buy on margin, you are amplifying your gains, but you are also exposing yourself to forced liquidations if the market turns against you.
Exactly. And we really must contrast that aggressive, leveraged retail buying with the behavior of systematic traders right now. Systematic traders, which are often referred to as CTAs or commodity trading advisors, operate entirely differently from retail investors.
Right. They are purely computer-driven trend followers. These algorithms, they do not read earnings reports, they do not watch financial news, and they certainly do not care about macroeconomic policy.
No, they don't. They're programmed strictly to buy blindly when an asset's price trend is moving upward and aggressively sell when that trend breaks downward. And right now, the data shows that systematic re-risking is largely maxed out.
Yeah, these algorithmic funds are currently holding massive long positions across global equities, but their buying power is entirely exhausted. They are sitting idle.
Right. They are not actively adding to their positions, but they are holding a significant percentage of the market's total capitalization.
Think of the dynamic this way. The retail investor currently has their foot glued to the gas pedal, driving the market forward through sheer leverage volume and entirely ignoring the rising temperature of the engine. Meanwhile, the systematic CTAs are acting as the market's automated cruise control.
That's a perfect analogy. They are entirely passive right now, just maintaining the speed. But that cruise control has strict mechanical limits. If the market hits a specific speed bump and our internal data pinpoints that exact technical trigger at the 70-95 point level on the S&P 500, that algorithmic cruise control will violently disengage.
And it is crucial to understand that it does not just turn off. When those algorithms hit 70-95, the car suddenly slams into reverse. Because these systematic funds are programmed to automatically dump their massive holdings, crossing that threshold triggers an immediate automated wave of selling.
Selling that operates entirely without human intervention. So to anticipate what could force the market down to that 795 point trigger, we must examine the broader macroeconomic forces currently applying severe pressure to the system.
Right. The macro backdrop is key here. The OCM factor trends show that the secondary engine in our model, which is rates and inflation, remains stretched in a positive direction. And this creates a severe disconnect between what the market expects and what the macroeconomic reality actually dictates.
It does, because the prevailing narrative on the street is heavily predicting a dovish central bank. You will read consensus reports everywhere expecting 2 25 basis point rate cuts in the near future.
However, that is not how the institutional money is actually positioned. The actual market where institutions hedge their real risk is currently pricing in roughly 18.5 basis points of Fed hikes by the end of 2026.
Just to clarify for everyone, a basis point is 1/100th of a percentage point. So the street is telling you rates will fall, but the actual flow of money is preparing for rates to go up. Global yields are surging in response.
Yeah, we are seeing sustained upward breakouts in both the U.S. 10-year and the German 10-year government bonds.
And in addition to the rising cost of capital from those surging yields, we have persistent geopolitical inflation vectors. The ongoing closure of the Strait of Hormuz is severely restricting global shipping routes right now.
Which is a huge supply bottleneck. It has kept Brent crude oil elevated at $111 a barrel. And for the broader economy, oil at $111 does not just mean higher gas prices for consumers.
No, it acts as a persistent, unavoidable inflation tax on every single aspect of corporate margins and consumer spending. It makes literally everything more expensive to produce and transport.
And this combination, the surging yields and elevated energy prices, has triggered a critical structural shift that directly impacts the diversification of your portfolio. Historically, stocks and bonds often move independently.
Right. But recently, The correlation between equities and the 10-year bond yield has turned sharply negative. In fact, it is the most negative correlation we have observed since the late 1990s. We really need to explain exactly why this is so dangerous.
Well, the implication of that negative correlation is profound. In a standard, healthy economic expansion, interest rates rise because economic growth is accelerating. Equities can comfortably digest those rising rates because corporate profits are expanding simultaneously to offset the cost.
But that is not what is happening today. The market now recognizes that rising yields are a direct, prohibitive headwind.
Exactly. When the 10-year yield surges, the risk-free rate of return goes up. If an institutional investor can get a guaranteed high return from a U.S. government bond, suddenly the mathematics behind taking a risk on a hypersensitive technology stock completely falls apart.
The cost of capital just becomes too high, which actively chokes off equity momentum.
So with retail investors financially stretched on margin and systematic algorithms sitting idle just above a 70-95-point tripwire, plus these macroeconomic pressures rising, we must look at the actual plumbing of Wall Street.
Right. We need to understand exactly how the market infrastructure will handle a potential shock. And this requires demystifying a structural concept known as dealer gamma.
Let's break down the mechanics of dealer gamma for the individual investor. Options dealers are essentially the ultimate middlemen of Wall Street. When you, or a massive institution, buys a put or a call option, there is a dealer on the other side taking the opposite side of that trade.
And these dealers have absolutely no interest in betting on the direction of the market. Their entire business model is simply to collect the transaction fees and remain perfectly neutral.
Right. To maintain that neutral stance, they must constantly buy and sell the underlying stocks to balance their books as the market moves.
Right now, around current price levels, meaning any market movement between 0 and positive 2%, these dealers possess what is called positive gamma. In plain English, positive gamma means these dealers are acting as massive shock absorbers for the market.
And the mechanism behind that shock absorber is purely mathematical. If the S&P dips slightly, the dealers' risk models force them to buy stocks to rebalance their neutral position. If the S&P rises slightly, they are forced to sell.
Right, so this continuous automated buying of dips and selling of rips artificially dampens market volatility. It keeps asset prices trapped in a very tight, stable range, creating that illusion of calm we see on the headline news.
But that stability is a facade masking significant structural risk. Our market intelligence reveals a massive, heavily concentrated zone of negative gamma lurking just below current price levels.
Okay, and if the market experiences a sudden drop of between 3% and 10%, or ironically, a rapid upward spike of 5%, the dealer's positioning flips entirely.
When the market crosses the threshold into negative gamma territory, those shock absorbers instantly transform into market amplifiers. If the market drops 3%, dealers are no longer buying the dip to stay neutral.
No, because of the way the options math works, their models now force them to aggressively sell stocks into an already falling market, just to save their own books.
We are seeing localized powder kegs of this specific risk already. The shadow gamma embedded in leveraged semiconductor ETFs has nearly doubled in just the last 6 weeks. That means there is a staggering amount of hidden leverage relying on the market moving in only one direction.
Right, and when we outline this institutional risk, a common rebuttal is that corporate stock buybacks will act as the ultimate safety net. People ask, can the continuous stream of corporate share repurchases step in and save the day if one of these negative gamma events is triggered?
And the short answer is no. Corporate buybacks certainly provide a steady, reliable floor of demand under normal, quiet conditions. Companies utilize their excess cash to reduce outstanding shares, which supports prices over a timeline of quarters and years.
However, buyback execution is methodical and slow. It is entirely insufficient to counteract a violent, machine-driven, negative gamma cascade. A systematic liquidation event happens in hours and days, driven by algorithmic triggers firing off instantly.
Right. Corporate treasurers simply do not operate with the speed or the concentrated daily volume necessary to absorb a sudden, massive supply shock of that magnitude.
Which brings us to the ultimate risk currently facing your portfolio, and what our proprietary modeling formally identifies as the pain trade.
The prevailing street narrative is entirely comfortable with the current momentum. They are completely ignoring what the OCM-PCA model classifies as the euphoria volatility trap.
Right, because so many investors are aggressively concentrated in a few highly volatile tech names, and operating entirely without downside hedges, Our model projects a massive impending volatility spike.
Based on the current mathematical parameters of this euphoria regime, the model anticipates the equity VIX index to jump by over 9 points. More concerningly, it expects the MBE index to expand by over 8 points.
And for clarity, think of the movie index as the fear gauge, similar to the VIX, but specifically measuring volatility in the bond market.
We are already observing the initial fractures in the market's foundation. The artificial intelligence momentum trade, which has functioned as the sole pillar of the recent rally, just suffered its worst two-day sell-off since 2022.
Furthermore, we really must look at key international indicators. The Kospi index in South Korea is currently facing severe foreign selling pressure.
Right. Despite long-term institutional targets projecting the Kospi to reach the 9,000 level, international capital is actively liquidating its semiconductor exposure in that region right now.
The smart institutional money is already de-risking the exact same sectors that retail money is utilizing margin to buy.
So, to protect your capital in this environment, you must implement institutional-grade defensive measures immediately. First, execute an up-in-quality rotation in your portfolio.
Meaning, actively move capital out of small-cap equities and highly volatile momentum names. You should reallocate that exposure into large-cap equities and traditionally defensive sectors, specifically healthcare and consumer staples.
Exactly. These sectors possess the fundamental balance sheet strength required to weather a sharp, sudden contraction in market liquidity.
Second, you need to adjust your geographic focus. You should actively overweight developed markets while simultaneously trimming your exposure to emerging market debt.
Because, as we established earlier, global yields, specifically the U.S. 10-year, are rising sharply. That rising cost of capital will actively sap the total returns from emerging market bonds, which are highly sensitive to both a surging 10-year yield and a strengthening U.S. dollar.
Finally, you must hedge your tail risk. Our primary house view strictly dictates enforcing a long but hedged bias right now.
The data clearly shows that volatility protection, specifically put options and tail risk hedges, is currently priced exceptionally cheap. This is because the positive gamma environment we discussed earlier is artificially suppressing the VIX.
So it is absolutely imperative to purchase that volatility protection right now while it is inexpensive, before the dealer gamma flips negative and the cost of hedging skyrockets. You want to buy insurance before the house catches fire, not while it is burning.
Exactly. We will leave you with a final structural scenario to evaluate over the coming days. The internal data definitively proves that retail investors, utilizing heavy margin debt, have been the sole liquidity sponge absorbing the recent institutional selling in the tech and momentum sectors.
So consider the severe structural implications for asset prices next week if those retail margin accounts finally tap out and face forced liquidations on the exact same day that our systematic trend followers cross their 7295 automated sell trigger.
See you next week, wherever the flows take us.